All right, good afternoon. We are now live and recording. So welcome to the IHCDA HOTMA training. As you will see here from the title slide, we're going to be focusing today on really thinking about how HOTMA affects some of the primary capital funding programs. So thinking particularly about how does HOTMA affect the low-income housing tax credit compliance, the home program, the National Housing Trust Fund. But the reality is a lot of these policies we're going to be talking about have much broader implication and will apply across many affordable housing programs. And we'll talk just a little bit more when I get to a disclaimer slide about what we will and will not cover today. Okay, so this is our agenda to get through here in this 90-minute session. We'll start very high level, just making sure we're all on the same page with understanding what is HOTMA, what is this all about, why should we care? From there, we'll dive in a little bit to thinking about the applicability. So which programs are affected by HOTMA and when are they affected? So we'll take some time to really understand the different kind of timing that's out there. From there, we'll dig a little bit into the HUD guidance. So talking about what do we know so far? What is the official guidance or notices we have received? We'll acknowledge some areas where maybe we don't yet have answers or where we know that additional guidance is coming, but we have enough information to continue moving forward with our implementation. And that's where we'll spend most of the day is talking about what does all this guidance tell us? What do we need to do different going forward? So through HOTMA, you'll see there's really a number of things that potentially change, and it's really all about the way that we qualify and determine eligibility for households. So there's a minor change to the way we handle the definition of who is and isn't counted in a household. We'll talk about that. We'll go a little bit into what HOTMA changes on the side of how we calculate and what we count in income. And then we'll spend a lot of time. Really the biggest, meatiest change in HOTMA is the way we handle assets. So we'll make sure to talk about really, you'll hear me say this probably a couple times, but it's almost forgetting what we knew about assets and relearning on the asset side. So we'll make sure to spend plenty of time there thinking through what this means for asset calculations. And then kind of the major content will end on the side of verification. So talking about a number of ways that HOTMA updates the way that we can verify items. I want to say up front before we dig into this, yes, it's a lot to learn. Yes, change can be hard, especially for compliance professionals who like things very black and white, and you got your certification 5 years ago and you hoped the rules would never change. But the reality is, as we go through this, I hope you will see that while, yes, it's going to require updating processes and forms and retraining ourselves and our staff, that a lot of these HOTMA changes, especially when we talk about like the verification side, they really are positive things. They streamline the program. They should reduce burden on owner agents, on tenants, et cetera. And we'll wrap up with a little bit of next steps, some recommended action steps for you as the audience, as well as sharing some next steps on what IHCDA has done so far towards HOTMA implementation and where we are heading over the coming weeks. All right, so I have to start with just a couple disclaimers here. For those of you who were on my Inspire training earlier this week, very similar disclaimers. And that is that this is all, of course, very new, hot kind of breaking stuff. So this material we know is subject to change with additional guidance that we may receive. Some of this we know there will be areas we get additional HUD guidance, some we may or may not. But today, we just need to acknowledge that this training is what we know as of November 29th at 2 p.m. Eastern Time. Certainly things could change and have been changing over the last few months. And then finally, this is not a fully comprehensive HOTMA training. We could certainly spend all day going through HOTMA. Rather, as I said, we're going to really focus on some of the broader, more universal parts of HOTMA. What HOTMA means for the way we calculate income and assets, how we do verifications, and then particularly how that impacts tax credits, home, housing trust fund, and kind of similar programs. Now, that does not mean that those of you who work on other programs won't benefit from this, because again, much of it's going to be the same, the way you calculate income and assets. But we're not going to get into some of the very specific Section 8 or public housing stuff today that gets into things like new rules on when you have to do an interim reexamination if a household's income changes during the year. Public housing has some new rules on how we treat over income. There's new rules on how we calculate adjusted income for purposes of Section 8 and calculating calculating the tenant paid rent portion. So there are some special things when we get into some of those HUD programs, particularly Section 8 and public housing, that is outside of today's scope. If you work on those programs, would certainly encourage you to read the various implementation guidance that HUD has put out and to find some additional training that's going to focus more on that side of the programs. All right, so what is HOTMA? HOTMA is the Housing Opportunity Through Modernization Act, and this is not a typo. Yes, it was of 2016. So way back in 2016, this HOTMA statute was passed by Congress with the goal of really kind of modernizing and streamlining the way we handle some elements of the housing programs, again, particularly the way we think about income asset calculations and verification. So HOTMA has been floating out there for 7 years, but we did not get a final rule until February of this year. And even with that final rule, there was a lot of things we didn't understand or that were later added on with additional guidance this fall. So it really has been an evolving item. With that 2016 statute, we knew it was coming. It wasn't effective yet. We've just been watching and eagerly waiting. And this year has certainly been that exciting year of all the HOTMA stuff coming out. Now, when you look at the actual HOTMA final rule, there's a couple of sections here. What we really care about the most across the board for our various affordable housing programs is Section 102. Specifically, those of us who are in the tax credits, home, housing trust fund world, this is really all that matters to us. So Section 102 of the HOTMA final rule is where we're going to find all those revised things about income calculations, verifications, what was considered an income and asset, et cetera. So that's really the bulk of it, as later more expanded and defined through HUD guidance. For those in public housing world, Section 103 is important because it has the new over income rules for public housing. Again, I won't go into that today. And then there's a special asset limitation new rule for Section 8 in public housing. I'll talk just the very briefest about that when we get into the asset section. But for those who need to know more about this, you'll want to see Section 104 of HOTMA. Okay. So when we think about the applicability, the broad answer here is that HOTMA really does affect pretty much all of our affordable housing programs. We think about HUD really having a number of sides. We sometimes just think HUD is all the same, but there really are 3 key divisions in HUD that are funding housing, and they are all fortunately moving in a HOTMA direction, although as we'll see in a moment, that may be at slightly different timelines. So here we're talking about HUD multifamily programs. That's stuff like project-based rental assistance version of Section 8, Section 811 project rental assistance, HUD 202, PRACS, those types of traditional HUD rental assistance project-based type programs. We also have HUD Public and Indian Housing, which does the public housing program, as well as the voucher programs, both tenant-based and project-based vouchers. And then we get into HUD CPD, Community Planning and Development, that covers our home, housing trust funds, CDBG, those various programs as well. All these divisions of HUD are moving towards HOTMA. And as we'll see in a moment, not necessarily because the agencies have specifically said anything, but tax credits and RD programs, our USDA programs, are also affected by HOTMA because of their reliance on the quote Section 8 methodology of calculating income. And that Section 8 methodology is clearly completely changed by HOTMA. Now, when we looked at the original effective dates for HOTMA when the final rule came out, was that Section 102, again, that's all those income asset stuff, the asset limitations in Section 104 for Section 8. These are effective January 1st of 2024, so just over 30 days away. HOTMA is law of the land and effective, unless there's a specific extension in place, and we'll talk about what that extension is. The public housing rules actually were already effective all the way back to March for those new public housing over income rules. Okay, so we said unless there's an extension in place, well, there is one primary extension out there that affects HOTMA compliance, and we got this in 2 different ways. It started, HUD emailed all of the Public Housing Authority executive directors across the country, and then later followed up with an official formal Public and Indian Housing Notice, 23-27, and HUD basically said here, look, for PHAs, we know there's a lot to be done. PHAs rely on various software systems. They rely on various HUD forms, which aren't all updated. And PHAs are also required, depending on what programs they run, to create a variety of administrative plans. So PHAs administering voucher programs have to create what's called an HCV administrative plan. PHAs running public housing have to create what's called their ACOP. And HUD says, look, we know you have to go through those documents and update them to cover your HOTMA policies. They have to go through certain public comment requirements. You've got to update your software system. We understand it's going to be difficult for you. So specifically for public housing agencies with voucher programs and public housing, HUD has said you can wait. We want you to go as quickly as possible, become HOTMA compliant sooner than later, but you are authorized to wait as long as 1/1/25 to be HOTMA compliant under those public and Indian housing programs. So I think there's some PHA representatives on the call today. This is going to be a decision you'll need to make. Are you going live 1/1/24 like other programs? Are you waiting until the very last minute and going live with HOTMA 1/1/25, taking that extra year? Or you could do anything in between. You have that opportunity to launch, and HUD again wants you to go as soon as you are ready. For those PHAs in the audience, if you look at PIH Notice 23-27, you will see there's actually a very nice table that kind of shows you based on when your calendar year is for your voucher program, or your program year, I should say, and when you are required to submit your administrative plan. It gives you recommended dates to follow. Here's when you would need to revise your plan. Here's when it should be effective, et cetera. So that's a powerful table for our PHA friends. So let's look at the IHCDA programs then. You know, a lot of you on the call are very involved with IHCDA and our various programs. I know some of you are just industry friends who are interested in more HOTMA training. So whether you work directly with IHCDA or not, we're glad you're here. But IHCDA did recently put out a specific notice. You presumably saw it because that's how this webinar was announced. But Red Notice 23-53 from IHCDA was kind of our official policy statement on how we are implementing HOTMA. So what we said in this notice is that for most of our programs, basically everything except vouchers, so that covers the tax credit program and related programs like tax exempt bonds, TCAP 1602 funded projects. And then when we get into the HUD CPD type programs like Home, National Housing Trust Fund, CDBG, NSP, and then also some various other programs we run like the State Development Fund, our 811 PRA program, which is HUD multifamily, the State Housing First Small Rental Assistance Program, and then some, really pretty much any other IHCA program that has an income calculation except the voucher programs. HOTMA is effective 1/1/24, and we have definitively stated that in this policy. For the voucher programs, we have until 1/1/25 per that extension, but for our housing choice voucher and project-based voucher, we are currently targeting a 10/1/24 effective date for HOTMA. And part of why we're doing that is 10/1/24 is the deadline for PHAs to implement the new Inspire inspection protocol to replace their housing quality standards. And we're trying to just kind of align and go Inspire and HOTMA compliant on our voucher programs at the same time. Okay. So let's quickly go through what guidance do we have in hand. We'll share these slides. We'll get these slides posted on IHCDA's website along with this recording shortly after this training. So hopefully later this week, certainly early next week. So when you access these slides, there is a link here that can help you access all of these various notices. But these are really the key things that are important for us to have in our resource library as we try to understand HOTMA. So we have the original statute from back in 2016. Kind of interesting, maybe not as important as the recent guidance, right? There's the final rule from February of this year, released on Valentine's Day. My joke has been because HUD loves us. We then got those notices to the PHA directors that gave the voucher extensions, a notice telling PHAs as you put your policy together, here are the choices you have to make. So here's discretionary policies you'll need to put into effect. And then really the biggie here, if you only look at one of these, the big one is what's called the implementation guidance. This was a joint notice from HUD Multifamily and HUD Public and Indian Housing. So you'll see it has two notice numbers there. This came out on September 29th. This is the big one. This is a 100+ page notice that really explains how are we implementing HOTMA, not theoretical, not written in regulation or statute jargon, but written in plainer language. What does it mean for owner agents? What does it mean for PHAs? What does it mean for HFAs, et cetera? This is really the big one to make sure you have looked at. And for the rest of this training, what we're really going to be talking about is what does that notice tell us about income and asset calculations? So that's what we have. There are some things we do not have. So that HUD notice that came out technically applies to public and Indian housing programs, multifamily programs. The notice says HUD CPD, the side of HUD that oversees home, housing trust fund, et cetera, is going to put out their own notice. They've not done so yet. HOTMA is still effective 1/1/24. We don't have any extension. So for now, what we're really saying is we need to go ahead and rely on the existing HUD implementation guidance for other HUD programs. And if at such time the new guidance comes out from HUD CPD, it contradicts anything, we'll adapt and make changes that we need to on home and HTF. But really the expectation is that the majority of what we get from HUD CPD should be very similar with just some specific home and HTF flair. There's a few kind of home specific things we expect to see, but for the most part, we're hoping that it will align well with the other implementation notice. That will definitely come. The HUD has definitively said it will come. We just don't know when. The wild card is the IRS for our tax credit program, USDA for the rural development program. We do not know. There's no indication that either of these agencies are going to put anything officially out as far as guidance on how HOTMA affects the programs. And frankly, I'm in the camp that we don't really need them to do so. Where we know that HOTMA is going to apply in these programs is where we have regulations or guidance from these agencies that says we are to calculate income in a manner consistent with Section 8. Well, HOTMA clearly updates all of this for Section 8, so we'll be following the Section 8 rules as well. So just to prove that that's not something I made up, here is the existing Treasury regulation, what we all often call the -5 regulation. This covers kind of the compliance monitoring requirements under the Low Income Housing Tax Credit Program. And we have right in a federal regulation that income for the tax credit program is to be calculated in a manner consistent with the determination of annual income for Section 8. So straight in our regulation, it says do what Section 8 does. Section 8 has changed. We need to change as well. All right, so I've mentioned this, but I just want to put it again here in bold, right? Our policy, until such time that the IRS ever tells us something different, that HUD CPD tells us something different, et cetera, we are going to rely on that Public and Indian Housing Notice 23-27, that wonderful 100+ page memo, which spells out all of this in gory detail. How do we do income and asset detail calculations and verifications now? We are relying on that for purposes of other programs, and will do so until such time that something contradicts it. And we're hoping that that never happens, right? But that is our official policy statement. So as we move now into talking about what does HOTMA actually tell us, you'll see at the top of each of these slides going forward, there'll be a little parenthetical note with a number and or a letter in there. That is referring back to the implementation guidance. So my goal is to show you this isn't me making anything up or interpreting. This is directly what HUD guidance is telling us we need to do, and it will help you navigate your way through that large notice. So when you say, oh yeah, I want to look back at that part on assets Matt talked about, you'll be able to see a direct reference to say, I need to go and look at section, so-and-so. All right. So without further ado, let's dig into the actual changes. What are we now doing differently under HOTMA? And again, that is the focus of our training today, is what is different. So things that didn't change with HOTMA, this isn't a full income and asset calculation class, household definition class. That would take, a day or two to do all of that. This is really just what are the changes. So let's start on the household definition side. This is the area of least impact, because there's really just one primary change here related to household definition. So the change here is that we are no longer counting foster children and foster adults as household members. And those of you who have been in the industry a long time know this is an issue that's kind of gone different ways over different times with different versions of the HUD handbook. But what we are back to a situation where under HOTMA, so 1124 and beyond, we are not counting foster children and foster adults as members of a household. That means we don't count them for purposes of income limits. We don't count their income and assets as income and assets to the family because they're not considered a member of the family. We would, however, treat them when we're thinking about how big of a unit do we need to make sure that we're not overhousing or underhousing the household, so appropriately sizing a unit. So what does this mean? What it really means is, and HUD specifically says this in the guidance, right, is essentially we're treating foster children and foster adults in the same way we would live-in aides, right? So let's imagine we have a family where it is me, Matt, and I have adopted two foster children. I am now, once we get into HOTMA, that is now a one-person household. Those two foster children do not count as household members. You are going to need to calculate my income, ignoring any income from those foster children, and compare me to a one-person income limit. However, when you're determining what size of a unit do I need to meet occupancy standards, you are acknowledging that there are three people living in the unit, even though it's a one-person household for income purposes, okay? So that's the difference there. There is a clarification here where there is a difference between I have foster children that I am caring for versus I have my own child who has been placed into foster care. And HUD specifically says here, if I had, let's just say it's my biological son, and my son gets taken out of my household and placed into foster care, that is still considered a temporarily absent household member and would still be counted from my unit, even though they've temporarily been removed. So I know I've heard some people say this doesn't really make sense. The child who's removed, you are counting. Those who are living with you, you're not. This is the rule, okay? And that's the difference between foster children in my care versus my children who have been placed in foster care. Right. So that's the big change when we talk about household definition. Otherwise, we still count the same people we would have, and nothing changes in the way we calculate income and rent limits, right? It's really just we have to know how many people are in the household, and the fosters is the only change there. So now let's dive into income. A little more substantial here than the household definition for sure, but not as big a change as assets. Assets is going to be our big focus area. The first thing here, and this is a change, but maybe it's really not that much of a change. What HOTMA has done is to say, look, we're not going to do what we used to do in the HUD handbook, which is to say, here's a list of things that are specifically included as income sources. Here are things that are excluded. Rather, HUD's going to say, we're trying to simplify. What we're going to provide you is just that exclusion list. And HOTMA has provided an updated list. This would be attachment G of that implementation notice. So these are the things you must exclude, do not count as income. If it's not on that list, just count it. So we no longer have an inclusion list. It's just an exclusion list. Anything not on there must be included. We've always said, if not specifically excluded, count it. So it's really not too much of a philosophical change. It's kind of more of a presentation change or wording change here. The next change on the income side is related to child support or alimony or spousal support. And here we are now moving to a system of only counting amounts actually received. So the HOTMA implementation guidance tells us that annual income includes all amounts received, not amounts families are legally entitled to but not receiving. And this has always been an area where I know sometimes it's frustrating for owner and management agents trying to figure out what is someone entitled to get, are they actively trying to get paid, etc. Now we have a streamlined system. We are really just asking about and verifying what are you actually getting, and that's what we're counting. Amounts received, not the amount ordered or that they are entitled to. Now, the caveat here is HUD says because you now need to be counting specifically just that amount received, the old documentation you used to receive, like the court order or the written payment agreement alone, might not be sufficient verification. That's telling you the amount ordered. You need to verify an amount actually received. So there might be some additional questions that you need to ask. IHCDA has revised its sample child support or spousal support verification form that has already been posted on our website a couple weeks ago. We'll talk more about forms when we get to the end of the session, but just letting you know, we have provided a new sample that we think changes the questions to make sure to meet these receiving requirements. All right, so this one I think is a good change, right? It actually is going to streamline, simplify, and maybe not, count income that shouldn't be counted. This is not trying to present it necessarily as too much of a change, but we do get an updated definition through HOTMA of earned income. And the big takeaway here is that HUD is crystal clear that day laborers, independent contractors, and seasonal workers are receiving recurring earned income that must be counted. We cannot claim that day labor, independent contracting, or seasonal work is non-recurring and therefore excluded. And then we get specific definitions of each of these concepts. So a day laborer, someone that literally is hired and paid one day at a time. There's no agreement that they will definitely have any work tomorrow, but HUD says that is still recurring income. We're going to assume they're going to continue to do their day labor, and we're going to properly annualize out their pay. Independent contractors are individuals who qualify as independent contractors per the Internal Revenue Code. So here we're really talking about kind of self-employment, and the clarification from HUD. And we've been talking about this. There's been a lot of trainings over the last couple of years about what do we do now with the quote gig economy? How do we handle these emerging income sources? And HUD clarifies it here for us with the HOTMA notice that when you have these gig workers, that could be more traditional things like babysitting, landscaping, also moving into the more current gig economy stuff like rideshare, delivery apps, etc. These would be considered independent contractors. So we're treating them like self-employed individuals, and we are verifying and counting their income. And then finally, a seasonal worker would be someone who's hired for a short-term position, and HUD says that would usually be 6 months or less, that's dependent upon a certain season or weather. So they give examples of, summer work might be people working at parks, ballparks. You might have seasonal workers for the holidays coming up with Christmas season, extra workers on the retail side, dealing with snow plow drivers, scrapers, etc. But again, we would have to, do a calculation on how much are they estimated to work and count this as recurring income. So HUD then tells us a little bit more about this, about what would be non-recurring income. So it's not day labor, independent contracting, and seasonal work. What is actually non-recurring and therefore excluded from income? And we get a number of examples here. So things that we would not count as recurring income sources, these would be one-off things or otherwise excluded, might be things like a non-recurring assistance with paying a utility bill, some assistance I received as emergency rental assistance to prevent an eviction. I received some source to help me pay my security deposit to obtain housing. And then they say in general, other things like I'm participating in a research study that I'm getting a little bit of pay for, other general one-time kind of lump sum payments that I'm receiving. These would be non-recurring and we can exclude from income. And HUD specifically says you can absolutely take a self-certification from the household acknowledging that this income was a one-time thing that will not be repeated. Okay. Here's another list of specifically codified exclusions. So these are things that HUD explicitly says are non-recurring income. If you did employment for the Census Bureau, probably during a census year that lasts no more than 180 days and didn't result in a full-time job, so you were out doing census counting, that's non-recurring income that doesn't need to be counted. Federal or state payments related to economic stimulus and recovery, certainly a good amount of that went out over the last few years with COVID. State tax credits or tax refunds. We'll talk more about this concept later when we get to assets because we're excluding it as income here, and it also gives us kind of an interesting wrinkle on how to not count it on the asset side as well. So we'll put a pin in that, come back to that concept in assets. Gifts I'm getting often from family and friends, right? So things that are non-recurring. Hey, I got a Christmas card from my grandma with a check in it. I had a birthday, I had a wedding, an anniversary, a baby shower, etc. These are non-recurring income sources. Yes, those things may occur once a year, but we're not going to count in income. Non-monetary in-kind donations, this is kind of a new definition here. So if I am getting from something like a food bank or a similar organization is not defined. I'm hearing a lot of kind of industry consensus around really probably talking about from nonprofit type agencies, right? But if some type of social service nonprofit is giving me food, clothing, toiletries, etc., those non-monetary items are not counted as income, even if I go to that food bank every day. Okay. And then we've always kind of known this, a lump sum addition, like a one-time lottery winning, would not count as a recurring income source either. All right. So now we get to the biggest, maybe weirdest part of income changes within HOTMA, and this is the concept of how we calculate student financial assistance. Student financial assistance used to be really a pretty one, easy, and two, rare part of our income calculation process because the old pre-HOTMA rule said we only care and count student financial assistance if the household is receiving Section 8 assistance. So if they're just a tax credit or home household without a voucher, we don't care about student financial assistance. But that's no longer the case. So we're going to spend a little bit of time here on this. Hopefully, it's still not going to be an issue you just see popping up every day, but it is important to understand these new rules because they are much more widely applicable now. So when we look at student financial assistance now, the very first thing we have to do is understand that HUD views that there are two completely different types of student financial assistance. They don't necessarily label them type 1, type 2. That's language that I use just to kind of help keep things straight. But type 1 would be specific programs under the Higher Education Act, or the HEA, as I might say on some of these future slides. So these HEA financial assistance programs, specifically these federal programs under the Higher Education Act, that includes things like Pell Grants, Teach Grants, federal Perkins loans. There's a number of very specific tribal grant scholarship type programs that fall up under HEA that you'll see listed here. And then HUD says they anticipate updating this list around July 1st of 2024. So we'll get an updated list of what qualifies as an HEA type student financial assistance. Okay. Type 2 would be the other stuff. So that could be grants or scholarships that I am receiving from the federal government, but that aren't in that HEA list. They could also be coming from a state, territory, tribe, or local government. It could be a scholarship or a grant that I get from a 501c3. So a foundation has a scholarship program they award out. Some businesses award out scholarships. The educational institution itself has scholarship programs. So these non-HEA scholarships and grants are type 2 student financial assistance. And we're going to see how we count when we get to our calculation. We have to kind of bifurcate these out and calculate them differently. Okay. Now, neither of these, neither type 1 nor type 2, includes fees for services worked, or more commonly, gifts from family and friends, right? So my dear Aunt Edna is going to help me get through school and is sending me $100 a month to help me with my school costs. That would be recurring gift income that we would need to verify and count under the general gift income rules, but it's not technically student financial assistance, okay? So that is different than really receiving a scholarship or a grant. All right, so the next thing, so there's two types of student financial assistance, and then there's also kind of two paths of what are we gonna do? Hopefully one day this will align. We'll talk more about that in a moment. But for now, starting HOTMA on 1/1/24, we really have two different kind of paths for student financial assistance. The first is, what do we do for our non-Section 8 programs? So we have a household that is not on a voucher, not in a Section 8 unit. How are we going to calculate out their student financial assistance? Well, we're going to exclude that type 1 HEA type stuff, and we'll show how to do this math in a moment, okay? So we don't want to count the HEA stuff. The type 2 non-HEA assistance, we are going to include either in amounts by itself, or when in combination with type 1, it is exceeding what's called actual covered costs. This sounds confusing. We're going to show this what it looks like in a formula, and then we're going to walk through multiple examples to make it make sense, okay? So this concept is important, this new term of actual covered costs. This is a broadened definition from what we used to have on the Section 8 side. But the covered costs, it covers my tuition, my book fees, other supplies that I need for my classes, including supplies to help persons with disabilities go to school, room and board fees, other fees required and charged directly by the institution of higher education. And then if I'm a member of the household, I'm not the head, co-head, or the spouse, my mom and dad are the head, and I'm going off to school. If I have a cost of obtaining other housing in a dorm or an apartment near that school while I'm going there, those extra costs would also be counted as actual covered costs towards the student financial assistance, okay? Now, I'm not going to go over this. This is here for for slide purposes as a reference. This is chart G1 straight out of the implementation notice. This is how HUD lays it out in block paragraphs. I know people like to learn in different ways. If you like to look at a bunch of words and block paragraphs, this explains in paragraph form, a two-step process that you need to go through in order to correctly calculate student financial assistance. And we'll show the examples in a moment, okay? What I have done here, because I know some people would rather see this, less words, and think more kind of from a mathematical standpoint. Some of you say, oh my gosh, no, I hate math. But if you do connect more on kind of math or an algebra formulation, here's a formula that says the same thing in less words, right? So my step one is I'm going to figure out what are those actual covered costs, the book, tuition, et cetera, all of that. I'm going to subtract out from the amount of actual cost. It cost me this much to go to school. I subtract out how much type 1 HEA student financial assistance I'm receiving. The difference between those I'm calling X, okay? So we get number X, that's the difference. And essentially what that difference is what of my costs are not covered by the HEA financial assistance, okay? I then go to step 2. Now I have to take all that other student financial assistance, so the other scholarships and grants that I may be receiving. From that, I subtract out that X number, and that gives me what is presented here as Y, and that is the number that I count towards my income. However, if the number is negative, I count 0 as income. I don't get to offset other income sources with a negative number, okay? So again, maybe neither of these. Maybe you don't like the paragraph or the math. Maybe what's going to help is showing some case studies. So we're going to walk through 2 or 3 examples here. And these examples are straight out of the HUD implementation notice. I have not altered these. I have run the math and confirmed I agree with them. They do work. So let's walk through these examples. So our first example, we have Juan, who's a full-time student. And he is getting a federal Pell Grant of $25,000. The university gives him $15,000, and the local Rotary Club is giving him a $3,000 scholarship as well. All right, so step 1 is we're going to say what are the actual covered costs of attending school minus his type 1 HEA stuff, okay? So we see here on the slide, HUD has told us Juan's actual covered costs, $28,000. So in step 1, we take $28,000, the actual covered costs, minus the type 1 HEA assistance. In that case, the only thing on this list that is type 1 is the federal Pell Grant of $25,000. So we take the $28,000 in actual covered costs minus $25,000 of type 1 assistance. And our first step here, that X in my calculation on the previous slide, is $3,000. Okay. Now, step 2, we have to say, what is all the other stuff, the type 2 assistance he's receiving, and subtract out from that X number. Okay, so we look at the Rotary Club of $3,000 plus the university scholarship of $15,000. So he's getting $18,000 of type 2 assistance. We subtract from that the $3,000 of remaining costs that weren't covered by type 1 assistance. That gets us $15,000. Juan's student financial assistance, once we move into HOTMA world, would be $15,000 a year of annual income. Juan is not on a tenant-based voucher or in a project-based Section 8 unit. Prior to HOTMA, this would have been $0 in income. If he would have moved in December of this year, we would have not counted that on his December pre-HOTMA calculation. But once he moves in after HOTMA, that's $15,000 of income. This is a big change on the way we calculate income, can absolutely affect household income qualification, right? So we've got to know these rules and understand how to do them. So let's make sure to look at a couple more examples. All right, we have Sarah, part-time student, We don't really care. Full-time, part-time doesn't really matter for these purposes of calculating student financial assistance. She got a federal Perkins loan of $2,000. The local car dealership gave her $500, and dear old Aunt Lois gave her $1,000. Okay. What we have here, we have three things. We have type 1 assistance. The federal type HEA assistance is just the $2,000 Perkins loans. Type 2, the other stuff, we're only counting the $500 local car dealership. Aunt Lois's gift is not going to be income. Now, in this case, it's just a one-time lump sum payment. It's not even recurring gift income. It was just a one-time and done. So it's completely excluded from income. If Aunt Lois was giving $1,000 a month to help with college, that would be a recurring gift, but not student financial assistance. Okay, so let's run the calculation. Step 1, we're going to take what are the actual covered costs. HUD has told us here Sarah's costs are $3,000 to attend school. We take that $3,000 minus the type 1 assistance. That's the $2,000 federal Perkins loan. That gives us our X here of $1,000. Okay. We're then going to go over here and say, okay, what is the other type 2 assistance she's receiving? Well, she gets $500 from the local car dealership. We subtract out the $1,000 of other student financial assistance she's receiving. That gets us negative $500. What does that mean? That means her out-of-pocket costs are more than what her combined financial assistance is paying for her, right? We don't get to offset other income with that negative 500. We're going to report $0 of income after we run this calculation. All right, let's look at one more here. Dante, full-time student, he gets a $9,000 federal Pell Grant, a $13,000 Perkins loan, and then the local library is giving him a $1,000 scholarship. Okay, so this is a different example we're going to see. The actual covered costs are $16,000. He has $22,000, $9,000 Pell Grant, $13,000 Perkins loans, $22,000 in HEA Type 1 assistance. That's more than his costs, right? He is getting more in assistance than he actually needs to cover actual covered costs. So when we take the actual covered costs of $16,000, subtract out our Type 1 assistance of $22,000, we're at negative $6,000. Okay. HUD tells us we just kind of stop here, right? We're not going to worry about that negative 6,000. We just basically ignore that and say at step 2, anything he's getting from type 2 assistance just automatically counts as income. So that $1,000 library scholarship is more than he's going to need to pay. He's already got 6,000 more than he needs from the type 1. So the full amount of type 2 is becoming income. $1,000 of income for Dante. Okay. So it's kind of a funky rule. It's going to take some getting used to. We have built this into our compliance manual, kind of updated some forms here as well to help you run these calculations. That is on the non-Section 8 side, okay? But now we have households who are on Section 8, either a voucher, a tenant-based voucher, project-based voucher, living in a PBRA Section 8 unit. How are we going to treat our Section 8 households? Well, Section 8 has kind of always had this special exception, so we still have to look at this multiple ways. This decision tree continues to grow. If the student who's receiving student financial assistance is the head, co-head, or spouse, and is over the age of 23 with dependent children, okay, we're going to just follow that rule we just talked about. You get to use the new rule like non-Section 8 households, okay? If, however, the student is the head, co-head, or spouse, and they are age 23 or younger, or they are without dependent children, then we use more of the old Section 8 rule, which is we include any amount of assistance in excess of tuition plus other required fees and charges. So this definition was expanded. Under the old Section 8 rule, it was just in excess of tuition and fees. These other fees and charges are now the same as actual covered costs. It's expanded to that full list: tuition, books, lab fees, etc. Okay, lots going on here to keep track of. So if our student is the head, co-head, or spouse, age 23 or younger, or without dependent children, that is where we're going to have this extra rule. So let's dig in here and look at how this is going to work with an example. We have Roberto. Roberto is 22-year-old full-time student without dependent children. Okay. So in this case, he is in that second group, right? He is under 23 or without dependent children. He is both of those. We're not going to apply the new HOTMA rule. We apply the old Section 8 rule, which says whatever amount of assistance he's getting above tuition, we're not going to break out between type 1 versus type 2. We're going to lump it all together. Assistance in excess of tuition and other actual covered costs must be counted as income. So here we just add up everything, 12,000 federal Pell Grant, 25,000 other. We don't break them into type 1 versus type 2. He has $37,000 of financial assistance. It costs him $27,000 in actual costs. The difference there is $10,000. All $10,000 gets counted as student financial assistance in income. Okay. Now, here's a different one. We have Angel. She is 38 years old. She is the head of household without dependent children. Okay, so she's not under 23, but she still doesn't have dependent children. So she falls into that second category. And we are going to have to look at this. So here we go. She's 38 years old, no dependent children. We are following then our rule here. We're looking at the total amount of assistance she's receiving, which is $8,000 through the Perkins Loan Program. We're not separating out necessarily looking at different calculations here, type 1 versus 2. Her total tuition actual covered cost is $6,200. So we take the $8,000 minus $6,200. So her total assistance minus total costs, $1,800. The entire $1,800 is counted as financial assistance. Okay. If she would have met that other, if they would have had that other definition, right? So when we go back and say, well, wait a minute, what if she would have been over the age of 23, she was 38, she did have dependent children, we said she didn't, well, that's when we would have applied that new HOTMA rule and would have had to look at type 1 versus type 2. So wow, a lot going on here. We hope at some point in the future this aligns and we don't have to look at Section 8 versus non-Section 8, and we can just have one unified rule on how we are calculating student financial assistance. The issue is that the actual Appropriations Act language each year that Congress passes that appropriates funds to the Section 8 program, that language from Congress has specific language in it saying, here's how to treat student financial assistance for students. And HUD, when they looked at this, says, look, we don't think HOTMA can override that. We think we have to follow the congressional language in the Appropriations Act and use the separate student rule for, or the separate Section 8 rule. Now, if in the future, if the next Appropriations Act doesn't include special student financial assistance language, we can then align with HOTMA. So we'll have to wait and see. Hopefully Appropriations Acts in the future won't be that specific, okay? We had a question in the chat about how do I go about verifying actual covered costs? That's gonna be something you'll need to verify with the educational institution, right? Because they can tell you what are the costs of all these things, the fees, the books, the tuition, et cetera. And we do have an updated new student financial assistance form sample we've put on our website that asks those questions that you could send to verify both financial assistance received as well as actual covered costs. But yes, you would be going and verifying that with the institution. All right, good questions. Let's keep moving along. We're about to wrap up income and head into the fun of assets. So when we look at the last kind of piece of income here, these aren't really changes in rules, it's just the amounts are eventually going to change. So for a long time, we've had this rule for dependent full-time students, so not our head, co-head, spouse, right? But dependents in the household who are full-time students, we only count the first $480 of their income earned. That's a long-time rule. Many of us are familiar with that. The difference here is that HUD says that $480, which had been locked in for decades, that will now start to change. Every year, that number will be adjusted for inflation, presumably going up, and we will have to learn what that new number is. Okay, so this will be something to stay tuned. I've got a slide at the end that reminds us what are all the things that over time are going to change. Presumably, HUD's going to start putting out annual updates to a number of things under HOTMA. But that 480 isn't just used for full-time students. You may also be thinking, well, that's how we also determine what we count towards adoption payments, adoption assistance payments and income, same thing. So the old rule, assistance in excess of $480 per adopted child, we would exclude from income. We count just the first 480. The concept is still the same, but just like the previous slide, going forward, we're still at 480 for now, but going forward, that 480 will start to adjust by inflation on an annual basis, and we'll have to keep an eye out. The number will be the same, right? There'll be one number that we use for both of these purposes, dependent full-time students and adoption assistance payments. Okay. All right, let's brace ourselves. We've made it through a lot. I'm sure heads are spinning, but this is important stuff, and we can do this. This is work that I have full confidence we can do this together, right? Income, yeah, student financial assistance, pretty wonky, lots of things to do there. It's certainly going to need to see some flow charts and forms maybe to understand it. But how often are you going to see it come up? Maybe not too frequently. Assets is a much bigger change, really kind of turns the whole way we've looked at assets on their heads. And we know that, most of the households we deal with have some amount of asset, even if very small. So this is very important and critical to almost all of our files. We're going to start by talking about asset exclusion. So we get a new list of these are assets that do not get counted when we're thinking about household assets, okay? The bolded ones are ones that are kind of really specific with new HOTMA stuff and which we'll talk about in more detail, okay? The first one, this is a brand new concept, and we'll talk about this in much more detail, right? But the value of necessary items of personal property not counted as assets. We'll explain in a few slides what those are. Now, here's a big change. For non-necessary personal property, which includes things like bank accounts, I'll give a list of other items as well. If the total value of our combined non-necessary personal property is $50,000 or less, that'll be adjusted over time by inflation. We can't just memorize the 50,000 and move on. Then we actually exclude those assets. Now, you'll see in a moment, it's weird. We'll still count income from the assets, but we would list the household's assets as $0. Okay, we'll cover that in much more detail in a moment. Here's a good one. Then this one's easy. We are now excluding as assets the value of retirement plans. So yay, that's an easy thing under HOTMA we can all instantly understand. Retirement accounts no longer treated as assets, and never count the balance as an asset. Okay. The rest of these on this slide are things we probably were already excluding. Real property, land, a home, whatever, that the family doesn't actually have the authority to sell. If you receive amounts through some type of civil action or settlement because someone in the family became disabled due to negligence or malpractice, that settlement amount would not count as an asset to the household. Then there's some very specific educational savings accounts. The one that seems to come up most frequently, ABLE accounts, which help persons with disabilities save up to go to school. Those specific types of accounts as listed here are excluded as assets. This is one we don't see a lot. I wasn't even really familiar with this concept until I saw it in the HOTMA rules, but baby bonds are essentially state or local governments could set up funds to basically help children, babies from the time they're born, save up to have some money in a trust to help with future expenses, probably educational expenses. Those baby bonds would be excluded. Interest in Indian trust land. If I have a manufactured home where I'm receiving HCV assistance, that the equity in that home does not count. Similarly, some PHAs do a home ownership option where you can actually use Section 8 money to help become a homeowner. Equity in a home that's being assisted through HCV assistance would not be counted as income. If I'm a client of a public housing authority that has a family self-sufficiency program and I have some money saved in an FSS account, that's not counted. So those last three bullet points are very specific public housing authority type programs. And then here's where we get into more common things we may see. If I receive a federal tax refund or a refundable tax credit, not only is the tax credit not counted as income, we talked about that earlier, but also that amount is not counted as an asset for the next 12 months. We actually have to reduce it out of the asset balance that it has been deposited into, and we'll have a whole slide on that in a moment. Trusts. Some change here. Irrevocable trusts, we still do not count as assets. For a revocable trust, there's some questions we're going to have to ask, and we'll have a whole chart on that coming up in just a moment. So those are the things we would not count as assets. The big important concept, though, under HOTMA is that we now know that all assets fall into one of three categories of assets. We can have real property, so a house or a piece of land. That is included in the family's net total assets. I can have necessary personal property. Those will never be included. We'll look at examples on the next slide. And then I have this last category of other stuff. It's not necessary things to live. It's not a piece of real property. These non-necessary items are included in net family assets, but only if combined they exceed $50,000. Not if combined with real property, but just the non-necessary personal property itself when added all together. If it's over $50,000, it gets counted as assets. If not, we're zeroing it out, but income generated from those assets would still get counted as household income. So let's look at this difference between what's necessary, what's non-necessary when it comes to assets. So this type of assets that we're now calling necessary personal property, never counting as an asset in the asset calculation. These are items that are considered essential to the family to use the premises, as well as things that they need for their job, for their education, or for their health and wellness. Now HUD says, though, we're going to be reasonable here, right? We're not saying that low-income families can only have medical devices and work devices and school books, right? We understand there's just common stuff that everyone has just to have a basic existence, to help you just live your life in your home. Basic appliances, general personal products, etc. There's a whole list you'll see on the next slide. And then anything that helps someone with a disability to live their life is included as necessary as well. This does not include a bank account. You may say, well, it's really hard to live without a checking or a savings account, but HUD says it's not necessary. Other financial investments or anything deemed a luxury item. So then our non-necessary stuff, those bank accounts, financial investments, luxury items, etc. If the value combined, when we add them all up, if their value is over $50,000, eventually adjusted for inflation, that $50,000 will go up over time. Then we're going to include them all as assets, and we'll have to, for each individual asset, we will either be calculating an actual income from that asset if possible, if not an imputed asset income from that asset. That's different than how we used to impute, and we'll come back to that in a moment. If the total value of all my non-necessary items is less than or equal to $50,000, again, eventually adjusted for inflation, I'm excluding it all from assets. I'm showing the value of assets as zero, but any actual income earned, so interest, etc., would still be counted as household income. Okay, so it gets a little confusing there. We'll get used to this. This is definitely a big change in how we look at assets. This is a HUD chart, not going to read it all. This is table F1 of the HUD implementation guidance. You'll see necessary personal property is cars we need to get around, furniture, basic appliances, basic electronics. So we're not going to try to calculate a value on my TV, my DVD player, my PlayStation to say that those are luxury items. Basic personal effects, my wedding ring, etc. So the basic stuff we have, we live our lives, our belongings do not count. What moves into that category of non-necessary and would have to be treated as an asset is recreational or antique vehicles, recreational boats, my bank accounts, my financial investments, expensive jewelry, especially that I have as investments. So not a wedding ring, not my dear great-grandmother's necklace that she left me behind as my family inheritance, but I collect watches, I collect, diamonds, whatever it is, right? Other collectibles, I have a stamp collection, a coin collection, artwork, whatever it may be. These are luxury items that have a value and that would need to be included as assets. But again, only really being included if the total combined value of all of them together is over $50,000. We talked about this, retirement accounts. Yay, easy one. Now excluded as assets. This includes IRAs, 401ks, 403bs, self-employment retirement plans, etc. The amount of regular periodic payments that are coming as distributions, that's still income, but the amount sitting in the account is never an asset, okay? So here we have an example of a tenant who has a 401k with a balance of $157,000. They earn 5% interest on that, and the distribution coming to them is $12,000 last year. We anticipate it's going to be the same. We don't really care that there's 157,500 sitting in the account. We don't really care that it makes 5% interest. What we care, because that's asset stuff. We're not counting it as an asset. We're not counting asset income. What we only care about on retirement accounts now is what's the regular distribution coming in as periodic payments for income, $12,000 a year. So this is a $12,000 income source to the household, not considered an asset at all. Okay. Trusts. When we're looking at a trust, we have to look at a number of considerations. Is it irrevocable? Exclude it. That's basic. We've always done that. If it's revocable, there's a series of questions we have to ask. Is the trust grantor the person who controls the trust? Are they a member of the household, or does the household otherwise somehow have full control of the trust? If so, that's going to be considered an asset. If that grantor, the person who set up the trust, is not a member of the household doesn't control the trust, we're going to exclude it. If we are in a situation where we have to count a trust as an asset, then actual income that it generates, so interest it's earning, would be asset income, okay? And then we get into questions about, well, what do we do with distributions coming from this? So that could be the actual income, right? Would be the distribution. I don't know why I said income or interest. I'm sorry, I really meant to say distributions. So here we're looking at our distributions coming to the household. That would be the actual income. If the value of the trust is considered an asset, we're not also counting income. It's an asset to the household. If the trust is not an asset because it's irrevocable, because the household doesn't have control of it, then we have to look more carefully. Is the household getting a distribution? Well, how's that distribution exactly panning out? So what I like better than this paragraph is this chart that HUD has provided us, which tells us there's really three types of trusts and what do we do? So a revocable trust where the household has control. I'm sorry, that'd be the second one. A revocable trust where the household has control. Yes, it's an asset. Actual interest earned. I'm sorry, yes, so the actual interest earned would still be an income to the household, but the distributions would not. Okay, so sorry for the confusion there. Actual interest earned, yes, distributions not counted as income in this situation. Okay. Let's go to the other option. It's still a revocable, but no one in my household set up the trust or has control of the trust. It's not an asset now. So since it's not an asset, I'm not counting the asset income, the interest, but I may have to count distributions that are being taken out coming to me as periodic payments. So these regular distributions of trust, regular distributions would not be counted here, but distributions from the interest portion. So a distribution from the principal, no, this is where it gets really bizarre, but distribution from the interest would be counted unless that distribution is used specifically to pay for health and medical expenses of a minor. So now I'm in a situation where if I'm verifying that the trust is revocable, but not set up under the direct control of the household, they weren't the grantor, I'm not counting it as an asset. I'm looking to figure out, are they getting distributions? And now I have to drill deeper. Are those distributions coming from the principal amount of the trust? If so, not income. If they're coming from the interest earned, yes, unless they're using it for those medical expenses. Lots of questions to ask here. So we're going to have to really think about what we ask about trusts, how we ask these questions, and understand that HUD now thinks there's really three types of trusts. We used to really just think about revocable versus irrevocable, these two variations on revocable now, and two different places distributions could come from, either principal or interest. So gets a little messy. It wouldn't say maybe that that everyone's going to love this part. Hopefully we don't have a lot of tenants dealing with trusts. All right. Now, let's get back to this issue of federal tax credits and refunds. So we've talked about tax credits, refunds not being income. I teased earlier, we also have to figure out a way to take it out of assets. So when I'm receiving a federal tax refund, that has to come out of my assets. So let's think about what this means. Within the last 12 months, if I received a tax refund, and you as the owner agent have to prove you're not counting that in my assets, we're going to have to verify where did I put that money when I received the refund, how much was the refund, and then deduct it out. We've got to use the actual amount I received, not an amount that's anticipated. And so let's look at an example here. We have the Rodriguez family. Okay, so this is happening post HOTMA, so it's been predated or for 3/1 of 24. They received this federal tax refund of $4,500, and they're going to put it into their checking account. Okay. What you're really verifying at their recertification on August 1st is their assets, and you find out that they have $10,000 in their checking account. But now, because we're going to have to ask new questions on our questionnaire about did you receive a federal tax refund, you find out that they received a $4,500 federal tax refund. You prove they received that. They tell you it went into their checking account. When we look at the balance of the checking account, we're not counting $10,000. We're counting $5,500 because we have to deduct out that tax refund if it went into the account within the last 12 months. Okay, so it's not income and we can't count it as an asset either. So this is going to require a little sleuthing. Income questionnaires and asset questionnaires are going to need to ask questions about did you get a refund and what did you dump it into, because we need to make an adjustment to those accounts. All right. So actual versus imputed asset income, this is a change here that's very important to know. Our actual income from assets is always going to be included, okay? And that is regardless of whether the asset itself is going to really be included now, because we think back to that new 50,000 non-necessary personal asset rule. So I've got $45,000 of non-necessary assets. On my tick, the asset value is going to show as $0. But if those accounts are generating actual income, interest, et cetera, there would still be an interest portion. So it might look funky on a tick to say the assets is 0, but he gets $500 a year of asset income, right? Well, we're going to have to get used to that kind of funky looking thing that we're going to realistically see on ticks. So when would we impute under a HOTMA? Under the old rules, of course, if our total assets was going to be over $5,000, we were going to look at both an actual and imputed, but that's different now for two reasons. One, the new threshold is no longer $5,000, it goes up to $50,000, and over time will adjust by inflation. So if our total net family assets, non-necessary items and real property combined together, total value of assets is over $50,000, any asset that is included as an asset source and for which we cannot directly calculate an actual asset income, just for that specific asset, we are going to impute using the passbook savings rate, okay? It used to be we imputed the total combined value of assets. Now we're only imputing on very specific assets when that asset is included. The total assets is over $50,000, and we can't figure out a way to calculate the actual asset income for that particular asset. And we'll show a couple examples on this in a moment as well. Now this is from HUD. It looks a little blurry. That's kind of how it looks, unfortunately, in the implementation notice. But this is kind of a guide to help you think about when am I going to how am I calculating? Am I imputing or not? Okay. So the first box up here, the first diamond says, do net family assets exceed $50,000 adjusted by inflation? If no, my annual income from assets is just actual income. I'm not going to have to impute anything, okay? If instead, though, I go the arrow to the right, my assets do exceed $50,000, the question is, well, can I calculate an actual income, so an interest rate, for example, on that asset source? If yes, great, I don't need to impute it. I'm just taking the actual. If no, if I cannot calculate the actual income, then just for that specific asset, I'm going to impute on that. Okay, so no longer imputing on everything, only imputing specific assets in very specific situations. When we do need to impute, we're going to continue to use a passbook savings rate. For the moment, it's still at our 0.06% where it's been for a number of years, but effective 1/1/24, it goes up to 0.4%. Okay, so that is a bit of a bump, but we're going to be imputing, frankly, less often, right? HUD tells us going forward they will update this passbook savings rate every July. So we're not going to be able to just remember one number for years like we have the old 2% and then the 0.06%. Each July we're going to find out and have to start imputing based on that new number. Okay, so let's show a couple of examples and then we'll wrap up assets here. We have the Cross family, okay? And they tell us that they have three types of assets. They have a checking account worth $5,000, an engagement ring valued at $3,000, and a recreational boat. We now have to think about how do we classify these? Well, a checking account is non-necessary personal property, so that $5,000 is going to matter to us. We're going to need to consider it. The engagement ring, jewelry with family significance, and engagement rings, wedding rings. Under HUD's new chart, that's necessary personal property. We don't have to count it at all. So they've told us it's a ring worth $3,000. Great. We don't care. We're not considering that as we think about the assets. That recreational boat, though, that was a luxury item that fell into column 2. When we think back on that chart, that's not necessary. So that $15,000 estimated value counts as an asset. So we add it together, the checking account of $5,000 plus the boat of $15,000. This household has net family assets of $20,000. However, when we show that non-necessary personal property on our tick, we're showing it at 0 because it was less than $50,000. So let's take it a step further. Same example, we've determined they have $20,000 value, but we're counting it as 0 on the tick. However, the question then becomes, what do we do about the income? And this is where I said, remember, even if we don't count it because it was less than 50,000 towards the asset list, it still is going to count the actual income earned. This checking account with $5,000 is earning 0.07% interest. So even though we're listing it as $0 total assets, we would still count the income of $3.50 of interest earned. All right. Let's review on the assets here. And then from here, we'll go into verifications, which will cover some forms. And I know we have some forms questions. All right. So it's important. We've talked about this, but not all consolidated. The $50,000 number matters for 3 separate reasons. Okay. Our $50,000 threshold, adjusted by inflation over time, affects 3 different determinations. First is that question about non-necessary personal property. When our non-necessary personal property has a combined value of greater than over $50,000, we're going to include it. When it is less than or equal to $50,000, it is excluded. We're still going to count the income, but we're not counting the assets, okay? So the first thing the 50,000 matters is determining if we're counting non-necessary personal property or not. The second thing it matters for is imputing, which we just talked about. So we're only ever imputing when our total net family assets is greater than $50,000, adjusted for inflation, and then only for those specific assets where we can't calculate actual. So we've talked about those 2 things. But there's one more thing the $50,000 matters for, and that is determining when we can accept a self-certification. For tax credits only, in the past, we were allowed to self-certify when our assets were under $5,000. We now are going to go to $50,000. So if your total assets, non-necessary personal items plus real property, is under $50,000, we can now accept for all of our programs a self-certification of those assets. And that's where we're heading next. But before we do, last comment on assets. The slide is here for information. Again, this does not apply to tax credits, home, housing trust fund. Those of you in Section 8 and public housing world need to understand there is a new what's called an asset limitation. And what the asset limitation says is HUD has decided, you can agree or disagree, that if I'm an individual who owns over $100,000 of assets, or if I own real estate that is suitable to live in, that I should not be able to live in public housing or to receive Section 8 assistance. With some exceptions, if the house is not safe to live in, if it's a house I inherited that's across the country and my job and my work is here and I don't want to live in Washington where my grandmother passed away, if I need to get away because of domestic violence reasons, et cetera. So there are exceptions, but the general rule is you own a house or you own over $100,000 in assets, HUD is now going to exclude you from Section 8 or public housing, but we do not have to exclude them on tax credits, home, other programs. Okay. So I'm going to try to get through these slides and then we'll get to questions. We are nearing the end here. So our first item here is our self-certification of assets. So if net family assets, again, that is our non-necessary personal property plus our real property, is less than or equal to $50,000 adjusted for inflation, the rule specifically says the owner may accept self-cert at move-in and at recert, okay? Now there's some, when we get into Section 8 world where we're doing some interims and we're doing research to calculate rent adjustments, there are some times where every few years you would verify this. But for the programs we're talking about today, IHCDA policy will be at move-in and recert. You can always self-certify. Now, I do have a minor warning here. Those of you who saw me do a similar presentation a month or so ago saw this was just a regular warning. It's been downgraded. There has been some debate in the industry about does this apply to the tax credit program or not. Some states out there may still not allow you to use the 50,000 threshold. They may still go to the old 5,000 and below for the tax credit program. So proceed with caution if you have tax credit projects in other states. However, we have over the last month or so in calls I've been on with other states and through some industry groups, we're seeing more and more states adopt to the $50,000 rule, which is what IHCDA has done. And part of that has been because while it's not formal guidance, there are some IRS emails to states out there saying that the IRS is okay with 50,000 and considers the old 5,000 rule obsolete. So IHCDA is all in on this, but for your tax credit projects in other states, find out what they are allowing. The next thing on the verification side is what we call a hierarchy of verification. So HUD has put out this chart saying here are the preferred methods of verifying. Level 6 at the top, this is really in Section 8 world where we're using EIV, some of those upfront verification systems. When we get out of the EIV Section 8 world for the rest of the programs, this is the interesting part. HUD now says what we really prefer is still an upfront system that's not EIV, like some type of web-based benefit system or using the work number. So that has now become HUD's preferred method. IHCDA will still not require owner agents to use any method that costs money. So if using these systems is going to cost, you can choose to use it. You can't pass that cost on to the tenants, but you can move on to another source. So now the fourth highest level, the next best thing to get would be written third-party verification from the source, also known as tenant-provided verification. This would be things like our pay stubs, okay? So those of us who have been in the industry a long time, this has evolved over time. It used to be a third-party piece of paper filled out and faxed back from the employer was better than a pay stub. Then with the most recent HUD handbook change, now almost 10 years ago, pay stubs became equal. They're just as okay as a third-party verification. Now it's gone the completely different way. Under HOTMA, pay stubs are preferred. We would rather have pay stubs than an employer-signed piece of paper. That employer third-party verification or other third-party verification would now be, it's the fourth best thing. It's hierarchy 3 here. 4 is higher. So we would rather get pay stubs, direct bank statements, not have the employer, the bank, whatever, fill out a form and send it back to you. Then we get to the oral verification if we have to clarify. And last but not least, in most cases, self-certification is still the least preferred, except where HUD specifically says you can use self-cert, like when net family assets do not exceed $50,000. So in that case, skip all the higher, go straight to self-certification. There is another change on pay stubs. So the first change, they are now preferred to written third-party employment verification. The other change here is the number. So the old rule, we knew that kind of unhelpfully, the HUD handbook said 4 to 6 pay stubs. Now we are down to obtaining a minimum of 2 current and consecutive pay stubs. That's the standard for Section 8. That's what we're applying to tax credits. There is one exception here. Home and HTF and I'm hearing this will be the case with most PJs that award these funds. This is definitely where IHCDA is landing for now. Within the home and the HTF actual federal regulations, which I have cited at the bottom with that little asterisk, the actual regulations for these programs say they want 2 full months of pay stubs. So if you are getting paid weekly or biweekly, 2 current and consecutive that HOTMA would allow is going to fail the home and HTF regulation test. So for now, IHCDA is continuing to say, follow the stricter home and HTF rule, get 2 full months worth of pay stubs at such time that HUD CPD puts out their specific guidance for what HOTMA means for home and HTF. If they say ignore the home regulation, use the lesser 2 current, we'll be cool with that and we'll adjust our policy. But for now, we believe that we need to continue to apply the home and HTF regulation here. Okay. Checking accounts, another good change. We've for years said for savings accounts, we use the current balance, but checking changes too often. You need to do a 6-month average. That has gone away. This was in the implementation guidance from September. This was a surprise with that guidance. So what we now have is all these accounts basically are treated the same. We are obtaining one statement that reflects the current balance of all banking or financial accounts, including checking. So this is a good change. No longer getting 6 bank statements to calculate a checking account. All right, kind of the last piece of verifications here is thinking through, sometimes our tenants have already been income verified for other purposes. And HUD is acknowledging this and saying we would like to reduce the burden on our tenants as well as on owner agents. Tax credits has always kind of allowed this on the Section 8 side to say if Section 8 has already verified income, we can accept that and move on. We'll talk more about that in a moment. We now have home and housing trust funds, specifically those 2 programs, adapting that standard. So home and housing trust fund programs now say if the household's income has already been determined for a project-based rental assistance program like PBV or PBRA, you must, if you can get it, just use that calculation and not run another calculation yourself. Okay, so if you can get, for example, a statement from the PHA saying that we've already calculated their income for a project-based voucher, you're going to take that and you must use it and not go further. On tenant-based rental assistance, HTF, it's, HUD has to be a little different here. HTF says, yep, do the same thing. You must use that tenant-based rental assistance verification. Home says you may, but you don't have to. IHCDA is going to standardize it all and say, if you have a household in a home or an HTF assisted unit whose income has already been verified for purposes of a project-based or rental or tenant-based rental assistance program that is state or federal, you got to try to get that verification. And if you can, use it. Don't do your own calculation. Saves everyone time and energy. Okay. Now, when you do go to the PHA or the other program administrator, what you're trying to get is a statement from them that says one of 2 things. Either Matt's household has 3 people in it and he has an income of $30,000. Okay, good. You can now check that against your tax credit limit, home limit, rent, HTF limit, et cetera, and determine I'm income eligible. Alternatively, if all the PHA does is provide something and say, I have verified that Matt's income is under your tax credit income limit, that also counts. They technically don't have to tell you what my actual income amount is. Now, you're probably going to prefer it. That's going to be easier to list on a tick and in your software system. But if the PHA is only willing to say, yes, we're confirming it's under that income limit, but we're not telling you the amount, that is also acceptable. And the home and HTF program say you've got to go ahead and accept that and move on. So that leads to some questions. How would you show that on a tick in a reporting system? Some questions to be answered there, but that would be allowable income verification. On the tax credit side, we've always been allowed to do this from PHAs with the Section 8 program. So for tenants who are receiving Section 8 assistance, if we can get documentation that their income's already been calculated, we've always been allowed to use it from the IRS. IHCDA has always allowed it as well. That could be a special statement like we just talked about, or it could be, hey, we've got a copy of their 50058 or 50059, that tenant certification for Section 8 purposes. That's going to count as well. So no real change on tax credits. The change is now applying a similar rule over to home and HTF. But it goes deeper. This is the last part of income verification. It's not just rental assistance anymore. HOTMA says, look, a lot of our tenants are receiving other federal public assistance where getting that public assistance is based on their income. So they may have TANF, Medicaid, SNAP, which is food stamps, earned income tax credits, WIC, supplemental Social Security, SSI, not SSDI, just SSI, and then HUD may eventually announce other similar programs. But if you have a tenant who's receiving benefits from one of these programs, you can actually just get verification from that program administrator that would say, Matt has a 3-person household, and we have verified to get him on food stamps that household's income is $18,000. That could be a special form they fill out for you. It could be an award letter that has this information in it. And if that letter or is within 12 months of when you need it. So if the income determination effective date, the signature date on that letter, the effective date on the top of the report, if any of those dates are within the last 12-month period, that will count as verification, and you do not have to directly calculate the household's income. So this is great, right? I've heard some people say, well, I don't know that I like it. Why not use it, right? If these households have already probably gone through 5 income verifications to get various sources. Federal programs are saying they're income qualified. Get that report, put it in your file, move on. All right, next steps. And I know this is what most of the questions in the chat are about. So we'll start with what's next from IHCDA, starting with what have we already done. We did, at the start of November, put out an updated tax credit compliance manual, as well as a federal programs compliance manual. That covers home, HTF, CDBG, NSP, those HUD CPD type programs, okay? Those manuals are fully updated for HOTMA, also for Inspire, which we're not talking about today, but the new inspection protocols. And if you go to the summary of changes towards the start of the document, if it's related to HOTMA, it's marked as such in the summary of changes with some highlighting. So you can quickly go to that summary of changes document, see everything we changed related to HOTMA or Inspire, and then other changes are listed as well. Almost all the changes are HOTMA or Inspire for this year. We have also put out all of our sample forms, not yet the mandatory forms. So we have released an updated HOTMA compliant asset verification, bank verification, child or spousal support verification, employment verification form, a form to send to a PHA to verify the income they've calculated, a form to send to another rental assistance program administrator to verify they've calculated income, an updated student status verification form, and a brand new student financial assistance verification form to help you calculate that new student financial income. And then finally, a new form that you could send to the SSI office, TANF office, SNAP office, et cetera, to try and prove they've already been income qualified under a federal public assistance program. So these forms are either updated or new. These are live on the website. We announced these via a notice a few weeks ago. These are not mandatory forms. They are there for convenience. If you're using your own forms, you might want to look at these as guidance and make updates on your own copies. So where does this leave us? What do we still need to get out related to HOTMA? What most people on this call care about are the first 3 things. The TIC form, which really just needs updated on the asset section because the way assets are currently reflected on the TIC is the old way of imputing. So the TIC forms, the income questionnaire, which all households have to fill out to disclose what income and assets they have. We're adding all the HOTMA stuff into that. And then our old under $5,000 asset self-certification form is being updated to a $50,000 form that explains how the $50,000 test works. Those forms are all in draft format right now, and we should have those out no later than next week. So you'll see in the red notice that released all the other forms, we called that red notice Updated Compliance Forms Part 1. We said in that notice that these other forms were coming imminently. So look for a red notice within the next week that will have these forms. The TIC and the questionnaire are mandatory forms you must use. And we put in the compliance manual that the new forms have to be used for any files with an effective date of 3/1 or after. So we understand January, February research may already be done. You may already be working on March ones, but you will need to use the updated forms coming out next week for your March 1 files or later. Okay. If you're still processing January and February that aren't done, you're welcome to use the new forms on those as well. Last but not least, this is important because we want to be good partners in this work. and we do not want to penalize partners who are trying their best, okay? So we put this policy right in the manual, and I know we're slightly over time. We're going to go about 5 minutes over today. Stay with me if you can. If not, we understand. Thanks for being here. We are going to begin monitoring HOTMA compliance 1/1 of 24. HOTMA is the law of the land. As we go out next year, start doing spring and summer desktop file audits or on-site file audits, we will be checking for HOTMA compliance. However, we have publicly announced, this is in our compliance manual verbatim, that we are providing a grace period. We know you may already have certs that you had already completed. We know HOTMA is a steep learning curve, right? We have flown through 90 minutes today, and there's certainly more we could have discussed. So we want to be good partners. What we have said we will do for calendar year 2024, so for the first 12 months that HOTMA is effective, if we find during a file audit that you have messed up something specific to HOTMA, we will note it as an issue. We will require you to fix it, but we will not penalize you. We will not issue an 8823. We will not suspend you. We will not impose penalty fees, etc. Again, specifically linked to HOTMA. We're not going to buy you overcharge someone rent because of a HOTMA change, right? There's nothing in HOTMA about how rent limits work. Nothing in HOTMA about utility allowance. Nothing in HOTMA about keeping your unit in safe, decent, sanitary condition, right? So there will still be penalties. There will still be 8823s issued next year, but not for HOTMA specific income asset calculation items, okay? So we were doing a 1-year grace period. We'll continue doing more training throughout the year. What should you do then? That's what IHCDA has done. Review your template income and asset verification forms. If you are not using the mandatory IHCDA tick and questionnaire, which will come out next week, you'll have to then update your own version to make it compliant. We do allow companies that prefer to use their own version to submit a version to IHCDA for approval. We need to make sure it has all of our questions. You can add more stuff to it, but you can't take away. So those of you, that's a small number, that have an alternate approved tick or questionnaire will need to resubmit for approval. Of course, you'll need to review all your internal policies, procedures, train, and more train. And then don't panic. We can do this. A lot of this is good, right? There are things in this that are going to make our lives easier. Hopefully, we can take other programs, income verifications, and run with it. $50,000 asset, we're counting a lot less assets than we used to. We're not counting retirement accounts as assets. We're not getting 6 months of bank statements. There's lots of good stuff, right? Yeah, we got to wrap our heads around student financial assistance, and we've got to retrain our brains on assets. But a lot of this is really good stuff. We can do this. We're dedicated to providing more training like this. All of the trainings we do with third-party trainers next year will be updated with HOTMA information as well. All right, the very last slide. Here we are. Remember, stay tuned for future updates. That $480 that we count of dependent student income or foster assistance is going to start being adjusted annually for inflation. We can't get comfortable and just memorize the 480. The passbook savings rate going up to 0.4 in January 1st will then be updated every July going forward, okay? The $50,000 asset threshold, which matters for 3 reasons, which we talked about in detail, that's going to be updated for inflation, right? So we can't just memorize the 50,000 forever. HUD has said they may add more exclusions, more excluded income and asset sources. They may also add more safe harbor programs, other federal programs that have already verified income that you can accept, that you can rely on. So all these things might still be getting updated, maybe as much as annually. We'll need to stay tuned to all of that. And then for those of you with home and HTF, we will need to see what the official HUD CPD word is on those programs. If anything changes, IHCDA will immediately update its home and HTF compliance manual and go from there. All right, so I'm going to quickly run through the chat. I'm happy to stay on. I know some of you might have 3:30 obligations. I'll stay on until all the questions are done. So thank you all again. The first question was about when forms will be released, so we've talked about that. So yep, the questionnaire, the under 5,000, and the TIC will be out within the next week. The new student forms are already out. Those have been out for a couple weeks now. Will we still third-party verify assets over 5,000? Nope, our new threshold is that 50,000, right? And that matters for those various reasons. So the question about will we have to third-party verify assets every 3rd year? For some programs that will matter. I think some agencies will say, well, it says to do it. We're being consistent with Section 8. We're going to do it at tax credits as well. So be aware of what your state says. IHCDA is not imposing that. We will just allow the self-certification on the tax credit side for all years. That is what appears to be in here for now. Lots of very nice comments. I really appreciate it. I hope this was, in fact, easy to understand and hope that this has demystified HOTMA a little bit. There were some folks saying, can we please get these slides? Yes. So stay tuned. When we put the red notice out next week with the final compliance forms, we will also in there. So the red notice will go out saying the final HOTMA forms are out. Here's where to link them. When we put those new forms on the web page, the IHCDA compliance web page, we will also put just the slide deck itself. And fingers crossed, assuming this recording worked out well and the audio is fine, we will also post this recording. So stay tuned. All of this stuff will be announced in the red notice and should be on the website certainly by the end of next week. So new forms, training slides, video, and if you do need more of this training, let us know. We're happy to continue to provide this in other settings. Any final questions? Okay. Well, you are all awesome. What you do is important. We thank you for being partners in our work. Don't hesitate to reach out. This is complicated. You're not bothering us. Send questions, email, call, let us know how we can help. But thank you all for taking the time to learn more about HOTMA and to make sure you stay in compliance. Thanks, everybody.